You know, usually when we start talking about wealth creation or like the stock market, there's this underlying expectation of momentum, thrill even.
Oh, definitely. It's very fast-paced.
Right. You picture the cinematic version of finance, the chaotic trading floor, the cascading green and red numbers on a terminal, someone aggressively clicking a mouse to execute a trade on the next big tech breakout.
And boom, wealth is instantly generated.
Exactly. But when you actually step out of that Hollywood fantasy and look at the unglamorous mechanical reality of long-term financial security, that high-speed momentum just grinds to a complete halt.
It really does. It's shockingly slow.
Yeah, it's remarkably slow. And
Yeah.
before you are even permitted to step onto that hypothetical trading floor, there is a massive, often invisible wall you have to scale first.
I'd call it the ultimate exercise in delayed gratification. And frankly, it's the exact place where the vast majority of retail investors make a fatal, unrecoverable error.
Which brings us to the core of our conversation today. For you listening right now, welcome to our deep dive. Today, we are looking at a financial blueprint that completely ignores stock picks, ignores market trends, and instead asks a somewhat brutal question.
Have you actually earned the right to invest at all?
Right. We are examining a really concise, hard-hitting set of notes, simply titled Preliminary Before You Actively Invest. And our mission here is to explore the widely ignored prerequisites of building wealth.
Because we live in an era where everyone is just desperate to skip straight to the finish line.
Oh, 100%.
Yeah.
But these notes provide the critical groundwork that absolutely must come first. Now, before we dive into the mechanics of this framework, we need to establish a very firm boundary.
Yes, the source material leads with a strict caveat, and we are adopting it wholesale for this discussion.
Absolutely crucial point. The text explicitly states that it is not financial advice. By the same token, our entire analysis today is absolutely not financial advice.
Exactly. We are simply embarking on an exploration of the experiential wisdom laid out in this specific document.
Yeah, you, the listener, must evaluate your own unique financial situation, assess your own risk tolerance, and make decisions entirely at your own risk. We are just the guides unpacking the philosophy behind this text.
And that philosophy is quite striking from the very first sentence. The text introduces what it calls a critical understanding.
Right, the foundational premise that individuals must, quote, count the cost before proceeding with active investing.
That specific phrase, count the cost, implies a level of sobriety and rigorous self-audit that runs completely counter to modern investing culture.
It really does. I mean, it completely flips the script on traditional financial media. If you consume typical market analysis, the entire conversation is relentlessly focused on the what.
Like, what ticker symbol should I buy?
Yeah, what emerging market is poised for a breakout? What real estate sector is undervalued? But this document frames the entire conversation around the when.
When have you fortified your financial life enough to actually endure the risk of the market?
Exactly. It reframes active investing from an assumed starting point to a privilege that must be systematically earned.
And to understand why that paradigm shift is so necessary, the text dives straight into the psychological hazards of jumping in too early. It issues a very stark warning.
Oh, the one about projected profits.
Yes. It says, don't fall in love with the projected profit experiences of others.
That is such a pervasive cognitive trap, especially for an audience that is constantly wired into financial news and data streams.
Oh, absolutely.
When I read that line about falling in love with the experiences of others, I immediately thought about the concept of survivorship bias.
Oh, that's a perfect connection.
Yeah, you know the story of the World War II bombers? The military looked at the planes returning from battle, covered in bullet holes, and initially thought, hey, we need to armor the places where these planes took fire.
Right, because that's where the visible damage was.
Exactly. But the statistician Abraham Wald pointed out their fatal logic. They were only looking at the planes that survived. The planes that got hit in the engines didn't make it back.
That is a phenomenal parallel. Because when we look at investing, we only ever see the surviving bombers.
Yes. We see the guy on a forum who bought out-of-the-money options and retired at 30. We see the spreadsheet with the immaculate 10-year compound annual growth rate.
We see the projected profit.
Exactly. What we do not see are the thousands of retail investors who blew up their accounts, panicked during a drawdown, and wiped out their life savings.
We don't see the unseen casualties, so we assume the anomaly is the baseline.
Right, and what's fascinating here is how modern financial technology weaponizes that exact cognitive bias.
Oh, it's completely engineered that way. Our brains evolved to seek out shortcuts to resources. When we hear an anecdote about someone doubling their net worth in 6 months, our neurological hardware latches onto that.
We just accept it as a viable, repeatable template, right?
Yeah.
Rather than recognizing it as a severe statistical outlier.
Exactly. And fintech apps and trading platforms are designed to amplify this. They gamify the experience, creating dopamine feedback loops that literally mimic slot machines.
Rewarding action and frequency over patience and strategy.
Precisely. The source text is explicitly warning against this because it leads directly to a catastrophic miscalculation of the time cost of active investing.
Right. The text actually assigns a specific multiplier to that time cost. It states that active investing could take 10 times as long as you thought to be successful.
That is a staggering metric. 10 times.
I mean, it's meant to be sobering, right? Let's trace the behavioral mechanics of that miscalculation.
Okay, let's do it.
Imagine you enter the market under the influence of survivorship bias. You've anchored your expectations to a projected profit that suggests you'll achieve life-changing wealth in 3 to 5 years.
You allocate your capital, and then reality sets in.
Yeah. The market trades sideways for a year. Then a macroeconomic shock triggers a 20% drawdown. You are now in year 3, your portfolio is in the red, and the dopamine has completely evaporated.
The psychological endurance required to hold through that is immense.
And most people simply do not have it because they didn't count the cost.
Right. When the reality of a 3-decade wealth-building horizon collides with a 3-year expectation, the investor's psychology breaks. They experience capitulation.
They sell at the absolute bottom of a market dip, just to relieve the emotional pain.
Permanently locking in their losses. Impatience, driven by comparing your baseline to the highlight reels of others, destroys compound interest.
You miscalculate the timeline. You exhaust your emotional capital long before your financial capital can mature.
And the market ruthlessly transfers your money to those who are patient.
So, for you listening, this requires a deeply honest self-audit. Think about the last time you analyzed a new investment opportunity.
Maybe it was a disruptive technology sector or a private equity syndication.
Yeah. How much of your enthusiasm was grounded in a rigorous analysis of the underlying fundamentals? And how much was secretly driven by the intoxicating allure of a spreadsheet showing a massive, frictionless, projected profit?
How much did that temptation cloud your judgment regarding your actual mathematical readiness to absorb a total loss of that capital?
Exactly. And the source material understands that mere awareness of this psychological trap is insufficient.
Right, because human discipline inevitably degrades under stress.
So instead of relying on willpower, the text mandates a strict mechanical evaluation process. It dictates a sequence of structural barriers you must build between your money and your impulses.
And the very first structural barrier, the absolute non-negotiable prerequisite before you allocate a single dollar to the market, is the establishment of a defensive perimeter.
The text calls it a safety net, but mechanically it functions as a financial moat.
The rule is explicit. You must have a fully funded emergency fund equal to approximately 6 months of expected income held in savings.
This represents a complete redefinition of the emergency fund, elevating it from a piece of generic advice to an absolute structural necessity.
It really does.
Now, I want to push back on this because I know the immediate objection from an informed audience. We're talking about highly optimized individuals who understand the corrosive effects of inflation.
Okay, let's hear the objection.
Taking 6 months of your income, which is a massive sum of capital, and leaving it in a static savings account feels actively detrimental.
Because of the lost purchasing power.
Right. If inflation's running at 3 or 4%, that cash is mathematically losing purchasing power every single day it sits there. Why not utilize a revolving line of credit for emergencies, or keep that capital deployed in a highly liquid ETF so it can at least outpace inflation?
That is the most sophisticated and simultaneously the most dangerous pushback in personal finance.
Really? Why dangerous?
It stems from fundamentally conflating the purpose of different pools of capital. You are evaluating the emergency fund through the lens of an investment.
Demanding that it yield a return or outpace macroeconomic forces.
Exactly. But the text is very specific in its nomenclature. It says, this is your safety net. It is not an engine for growth. It is an insurance policy against ruin.
Ah, I see. So the lack of yield is essentially the premium you pay for that insurance.
Precisely. Let us examine the strict parameters the source places on this capital. It mandates that this fund must be in a liquid account, meaning you can access it instantly without restriction or penalty.
Right.
More critically, it dictates that these funds must not be at risk. If you deploy your 6-month moat into a liquid equity ETF to combat inflation, you are exposing your safety net to a sequence of returns risk.
Because life emergencies and market crashes are not isolated variables. They are highly correlated.
Historically, they are intimately correlated. Look at any major economic contraction. 2008 is the classic example.
Oh, for sure.
The stock market loses 30, 40, or 50% of its value. Corporate earnings plummet, which immediately triggers mass layoffs.
Right. So if your emergency fund is tied up in the market to beat inflation, the exact macroeconomic event that costs you your job is the exact same event that decimates your safety net.
And if you rely on a home equity line of credit, the bank can and often will freeze or reduce that credit line during a liquidity crisis. You are left entirely exposed.
You essentially get margin called by life.
That is the perfect way to phrase it. The mechanics of liquidity require absolute separation from risk-bearing assets.
So the text points toward approved environments for this capital, like basic savings accounts or high-yield money market accounts.
Right. In a money market fund, you might capture a modest yield that closely tracks the federal funds rate, offering some insulation against inflation. But the absolute priority is the fiercely protected principal balance.
And if we extrapolate this out, the mechanical relationship between this static cash and your active investments becomes incredibly profound.
It really does. Let's run a scenario where an investor decides they are too smart for the 6-month cash rule.
Okay, let's say they want maximum capital efficiency, so they deploy every spare dollar into the market.
3 years later, they face a severe, localized crisis, a massive medical expense, or perhaps a 6-month gap in employment due to industry restructuring.
Because they lack liquid reserves, what are the mechanics of their survival?
They are forced to liquidate their portfolio.
They have to sell their assets, and they have to sell them regardless of the current valuation.
Exactly. If the market happens to be in a bear cycle, they are forced to sell deeply in the red, crystallizing massive losses.
They have surrendered all leverage and all control over the timing of their trades to external circumstances.
The profound realization here is that the emergency fund does not merely protect you, the individual, from the unpredictable chaos of life. The emergency fund protects your investments from you.
Okay, wait, let's unpack this because that completely changes the identity of the emergency fund.
Without a massive liquid moat, every bump in the road of life becomes an existential threat to your portfolio's compound annual growth rate.
Because you keep raiding the cookie jar just to survive.
Right. In order for active investments to succeed, they require time, decades, ideally to weather volatility and compound. By securing 6 months of income in a liquid, risk-free environment, you are buying yourself the psychological peace and the literal runway required to let your equities sit entirely untouched.
You have decoupled your daily survival from your long-term wealth building.
Exactly.
So the emergency fund is basically the bodyguard for the portfolio. You cannot expect the portfolio to survive the turbulence of the market if there isn't a dedicated allocation of cash standing watch at the perimeter.
That's a great analogy.
So, assuming the listener has executed this step, the 6-month moat is fully funded, sitting securely in a money market account, generating whatever modest yield it can while guaranteeing absolute liquidity. The defensive perimeter is secure.
The text then pivots from protecting against external macroeconomic shocks to addressing the most severe internal vulnerability.
The active sabotage we carry on our own balance sheets.
Yes. Rule number 2 in the source material, do not have credit card or consumer debt.
Now, to understand the gravity of this, we have to look at the mathematical mechanics of consumer debt versus market returns. There are highly intelligent people who try to actively invest in the stock market while simultaneously carrying a revolving balance on a high-interest credit card.
It is a fascinating psychological disconnect.
It really is. The text utilizes a benchmark of 15% interest for credit card debt, though, in today's environment, that number can easily exceed 20 or 25%.
The rule it establishes is absolute and uncompromising. You must direct your free cash flow to eliminate that debt entirely rather than deploying that cash into investments.
Instead of using dramatic metaphors about sinking boats, let's look at this purely from the perspective of institutional finance.
Okay, let's look at the math.
When you carry a 15 or 20% credit card balance, you are acting as a financial asset for someone else.
Right. A major banking institution is looking at you, and they have executed a brilliant, guaranteed return investment strategy.
You are their high-yield bond. They're generating a 20% compounded annual return off your balance sheet completely risk-free while you're taking that same money and throwing it into a volatile equity market, hoping to scrape together an 8 or 10% return. It is mathematical suicide.
It is an arbitrage where the retail investor is willingly taking the losing side of the spread.
It's crazy when you frame it like that.
Let us delve into the concept of the equity risk premium. When you allocate capital to the stock market, you are inherently taking on risk, market risk, geopolitical risk, sector risk.
Right. And in exchange for absorbing that risk, you demand a premium over the risk-free rate, which is historically around 7 to 10% annualized over long durations.
But as we established earlier, that return is highly volatile. It is never guaranteed in the short or medium term. You could experience a lost decade where your real return is 0 or negative.
Whereas the cost of your consumer debt is absolute.
Exactly. The cost of debt is a negative compound interest engine working against you with absolute certainty.
Right.
If you have debt costing you 15% in interest annually and you utilize your available liquidity to extinguish that debt, you have instantly and permanently stopped a 15% bleed.
Mathematically speaking, eliminating a 15% liability is functionally identical and structurally vastly superior to generating a 15% return through active, risky investments.
It's essentially a guaranteed, risk-free, tax-free 15% return on your deployed capital.
It is the holy grail of finance. Wall Street hedge funds deploy billions of dollars, utilizing complex derivatives and algorithmic trading, just to try and secure a risk-adjusted return that consistently beats the market.
And yet, the retail investor holding consumer debt has the ability to execute an absolutely guaranteed double-digit return on their capital simply by routing their cash flow to their liability column.
But the text makes a very specific note here. It says, this is especially true if you are a new investor.
Yes. That implies there is a significant behavioral hurdle specific to people just starting out.
Why does paying off a credit card feel like a penalty, while buying a fractional share of a tech company feels like investing?
It comes back to the concept of the investor identity and present bias.
Right.
When an individual decides they want to build wealth, they want to assume the identity of an investor. That identity is tied to accumulation. Downloading a brokerage app, analyzing a chart, executing a trade, these actions trigger a sense of participation in the capitalist engine. It feels forward-looking.
It's aggressive, like we talked about at the beginning.
Conversely, funneling your disposable income into a past-due credit card balance from a vacation you took 3 years ago feels inherently punitive.
It is an act of financial penance.
It lacks all the glamour and the forward momentum dopamine hit of Wall Street. It does not feel like you are building wealth. It feels like you are merely digging your way back to zero.
But the source material forces the reader to separate their emotional need for identity from the cold mathematical reality of their net worth.
Exactly. Moving your net worth from negative $20,000 to zero is identical in absolute wealth creation to moving it from zero to positive $20,000. The math does not care about the glamour. It is the ultimate alpha.
So, to the listener, this requires a complete paradigm shift regarding how you view your liabilities. Do not look at high-interest debt merely as a burden or a source of historical guilt.
Look at it as an extraordinary, fleeting opportunity to capture an immediate, guaranteed, double-digit return on your cash that you will likely never find in any public market in your lifetime.
Every dollar you deploy against that principle is a dollar that instantly starts earning a 15 or 20% risk-free yield by virtue of the interest you no longer have to pay.
It transforms the narrative of debt repayment from an exercise in deprivation into a highly aggressive, optimized financial strategy.
It entirely changes the game. So let us review the architecture we are building. The 6-month liquid moat is fully funded, insulating the investor from external macroeconomic shocks.
The high-interest consumer debt has been systematically eradicated, plugging the internal leaks and stopping the negative compounding engine.
Only now, having established this ironclad foundation, does the text permit the listener to look toward actual investment growth.
But crucially, the text still forbids active investing, as in picking individual equities or timing the market even at this stage.
Which leads us to the most powerful wealth creation engine in the entire document. The third mandatory rule before you are allowed to execute an active trade is max out your tax-advantaged funds.
The source material makes a remarkably bold claim here. It literally says you can become a millionaire on just these tax-advantaged accounts.
For an audience accustomed to seeking out alpha and generating complex investment theses, the idea of achieving a seven-figure net worth solely through basic retirement accounts sounds almost suspiciously simplistic.
It does.
How is that mechanically possible without taking on outsized risk to pick the next major market winner?
It sounds almost too mundane to be true, which is precisely why it is the most underutilized tool in the retail investor's arsenal.
Okay, break that down for us.
To understand how this works, we have to deconstruct the two massive mechanical engines driving this wealth creation, as highlighted in the source: the employer match and the elimination of tax drag. Let us begin with the employer match.
The 401k or a similar workplace retirement plan.
Yes. The text notes that typically an employer will match a percentage of your investment into these accounts. We need to translate that into return on investment metrics.
Right, so if your compensation package includes a 100% match on the first 5% of your salary and you contribute $5,000 to that account, the employer immediately deposits an additional $5,000.
You have just achieved an instantaneous, risk-free 100% return on your deployed capital.
Day one. Before the money is even invested in the underlying mutual funds or index funds, the capital has doubled.
There is no legitimate financial instrument on earth, no private equity deal, no hedge fund strategy that can offer a guaranteed 100% return upon execution. It is a statistical anomaly in the financial world.
Yet, behavioral economics data consistently shows that millions of employees leave this matched capital on the table every single year.
It's mind-blowing.
Why? Is it simply a lack of financial literacy, or is there a deeper behavioral friction at play?
It is a combination of present bias, valuing a smaller amount of cash today over a significantly larger amount of wealth in the future, and administrative friction.
Like the paperwork.
Exactly. The process requires opting in, selecting contribution percentages, and navigating archaic HR portals. People prioritize the immediate liquidity of their paycheck over the administrative hurdle of claiming their free capital.
It loops back perfectly to the narrative trap we discussed earlier. We are so blinded by the pursuit of complex, sexy, high-risk market plays that we literally step over piles of guaranteed capital provided by our employers to go gamble in the retail markets.
It is the ultimate irony. But the employer match is only the first stage of the rocket.
Oh, right. What's the second stage?
The second, and arguably more profound, concept the text introduces is the nature of tax-advantaged growth. The source states, the growth on the account is not taxed until you withdraw the funds.
This brings us to the concept of tax drag, which is perhaps the most destructive, silent killer of long-term wealth.
It truly is.
Let's do a deep dive into the mechanics of tax drag, because I think a lot of sophisticated investors understand taxes as an inevitable annoyance, but they underestimate the compounding mathematical damage it inflicts on a portfolio's compound annual growth rate over a 30-year horizon.
To conceptualize tax drag, think of your investment portfolio as an engine and taxes as aerodynamic friction.
Okay.
If you are actively investing in a standard taxable brokerage account, you are subject to friction at multiple points. Every time you execute a profitable trade and sell a stock, you trigger a capital gains tax event.
And if you hold dividend-paying equities, every dividend distribution is a taxable event in the year it is received.
Even if you automatically reinvest those dividends, the IRS still requires you to pay taxes on that distribution out of your own pocket.
Or worse, by selling off fractional shares to cover the tax bill.
Exactly. You are constantly bleeding capital back to the government. Let's look at the numbers. If your gross portfolio return is 9% for the year, but capital gains and dividend taxes shave off 2%, your net realized return is only 7%.
A 2% differential might sound negligible in a single year, but over a 30 or 40-year investing horizon, that 2% difference in your compound annual growth rate will literally cost you hundreds of thousands, if not millions of dollars.
You lose not only the money paid in taxes, but the compounding exponential growth that money would have generated if it had remained invested.
But inside a tax-advantaged account, like a 401k or an IRA, that aerodynamic friction is entirely removed from the compounding process.
It operates in a frictionless vacuum. Inside that account, you can buy, sell, rebalance, and collect dividends without ever triggering a taxable event.
You are allowed to reinvest 100% of your gains and 100% of your dividends year after year, decade after decade. The government does not touch a dime of that capital while it is compounding.
You are essentially earning compound interest on the money you would have owed the government.
That is the secret architecture of the millionaire factory. It is the compound growth of deferred tax liabilities.
Which is why the text issues a very simple, almost Zen-like directive that stands in stark contrast to the hyperactivity of modern trading. It says, let the money sit in a growth account and it will grow.
It relies on the immense mechanical power of patience and structural efficiency rather than individual stock-picking brilliance.
You do not need to time the market perfectly. You do not need to identify the next disruptive technology.
You simply need to capture the 100% return of the employer match, eliminate the friction of tax drag, and allow time to do the heavy lifting.
The juxtaposition between this section and the warnings at the beginning of the text is striking. In the opening, active investing was framed as hazardous.
Yeah, it was fraught with behavioral traps, prone to survivorship bias, demanding that you count the cost. Because the time horizon is a decade longer than you expect. It's a hostile environment.
But here, tax-advantaged investing is framed as a quiet, steady, nearly inevitable ascent. You can become a millionaire on just these tax-advantaged accounts.
There are no flashing red and green screens. There is no stress of earnings calls. It is just mechanical, systemic, unyielding wealth creation.
It is the difference between attempting to invent a new combustion engine from scratch in your garage versus simply plugging your car into a highly optimized, pre-existing power grid.
One requires immense active effort, assumes massive risk, and often ends in failure.
The other leverages a designed macroeconomic system that practically does the work for you, provided you have the discipline to follow the instructions and step out of your own way.
So we now have a complete view of the preliminary blueprint. The 3 steps, the liquid emergency moat, the absolute elimination of consumer debt, and the maximization of stealthy, frictionless, tax-advantaged accounts form a cohesive, incredibly resilient philosophy of personal finance.
Which brings us to the final section of our analysis, the architecture of wealth and the narrative framework that ties all of these prerequisites together.
The source material concludes with a very potent, synthesizing cautionary tale. It warns the reader directly. Don't become the narrative of the guy who didn't build a strong foundation before becoming an investor.
We all know the guy the text is referencing.
Every single person listening knows someone who fits this exact profile. If we synthesize everything we have analyzed today, we now possess a rigorous definition of what a strong foundation actually entails.
It is not an abstract concept. It is a fully funded, highly liquid 6-month cash moat. It is exactly $0 in revolving, high-interest consumer debt. And it is a maximized, consistent flow of capital into employer-matched, tax-sheltered accounts.
That triad is the foundation.
So the tragedy of the guy the text is warning us about is a tragedy of architectural sequence.
It is the individual attempting to construct the penthouse suite before they have even surveyed the land or poured the concrete for the ground floor.
Engaging in active investing, whether that means picking individual small-cap equities, participating in real estate syndications, angel investing, or trading options, doing any of that on top of a compromised foundation is not actually investing.
It is reckless speculation.
If you do not have the cash moat to absorb life's shocks, and you have the negative compounding engine of debt eroding your balance sheet, your active investments are built on tectonic fault lines.
You will inevitably make trading decisions driven by liquidity needs or desperation rather than objective market analysis. You are operating from a position of structural weakness.
And to hammer this concept of sequence home, the source text concludes by invoking a very specific framework from a well-known figure in the personal finance space.
It introduces Dave Ramsey and the concept of his baby steps.
It does, and it is the specific granular detail the author chooses to extract from Ramsey's methodology that serves as the key to unlocking the entire document.
Why end the notes by referencing Dave Ramsey?
The text highlights that in Ramsey's famous sequential framework, his baby step number 7 is building wealth. Let us connect this to the broader thesis of everything we have discussed.
Building wealth, which is the category where active discretionary investing finally resides, is step 7. It is not step 1. It's not step 2 or step 3.
It is literally the final stage of the entire program.
Exactly. And that singular fact perfectly encapsulates the philosophy of the source material. Wealth building, in the active, aggressive sense, is the absolute final stage of financial maturity.
It is a capstone, a privilege reserved exclusively for those who have patiently, rigorously, and systematically completed the preliminary groundwork.
You do not begin your financial journey by actively investing in the market. You must earn the right to graduate to active investing.
You graduate to it. That is a profound recalibration of perspective.
For you, the listener, analyzing your own portfolio right now, I strongly encourage you to honestly evaluate the structural integrity of your financial architecture. What step are you currently operating on? Are you attempting to skip ahead?
Are you pouring hours into fundamental analysis to pick the next big stock while a 20% credit card balance is silently hemorrhaging your net worth in the background?
Are you deploying capital into illiquid assets while your emergency moat could barely cover a blown transmission? If so, recognize that there is absolutely no shame in pausing. There is immense strategic pride to be found in taking a step back, liquidating some risk, and pouring that concrete foundation.
Do not rush the 10 house. Build the moat. Stop the internal leaks.
Because a mathematically sound foundation is the only mechanism that guarantees the penthouse will not inevitably collapse under the weight of external market pressures.
Absolutely.
Well, as we wrap up this deep dive, let's summarize the remarkable sequence this short source material just guided us through. We began by dismantling the cinematic illusion of the market. The realization that true, enduring investing isn't about jumping into the fray based on someone else's highlight reel, survivorship bias, or the intoxicating fantasy of a projected profit.
Instead, we discovered a disciplined, almost monastic sequence of prerequisites.
First, you secure a 6-month liquid moat to protect your portfolio from the unpredictable, highly correlated macroeconomic chaos of life. Second, you capture the ultimate alpha by aggressively destroying negative compounding consumer debt, guaranteeing your own double-digit returns.
And third, you quietly, systematically engineer millions in wealth by capturing employer matches and eliminating the devastating friction of tax drag long before you ever execute a single discretionary active trade.
It is a complete inversion of how the financial media trains us to behave. It prioritizes defense and structural efficiency over offense and stock-picking luck.
It truly is a masterclass in financial maturity.
And as we close, I want to hand it over to you for a final thought. We spent this entire time unpacking the mechanics of capital and risk, but the philosophy underneath these notes feels like it extends far beyond just a brokerage account.
It absolutely does. The source material fundamentally proves a paradox that most people struggle to grasp sometimes. The most profitable, highly optimized financial decision you can possibly make is the active choice not to invest.
Right.
We established that avoiding a 15% debt penalty is mathematically identical to and practically superior to a 15% investment triumph. The provocative question is how we might apply this exact mathematical logic to the broader architecture of our lives.
Consider the investments we constantly try to make in our careers, our relationships, or our physical health.
We are culturally conditioned to constantly add. We try to adopt new, complex productivity systems to get a promotion, or we buy expensive supplements and new workout equipment to optimize our health. We are constantly seeking the active projected profit of new behaviors.
But what if we paused? What if those areas of our lives would radically transform if we simply stopped trying to stack new, risky investments on top of a weak foundation and instead focus entirely on paying down our existing behavioral debt?
Exactly. If you are chronically sleep deprived, no new productivity hack will yield a return. That sleep deprivation is a 20% interest rate compounding against your cognitive function.
If you are exhausted from constantly trying to outpace your own fundamental vulnerabilities, perhaps the answer isn't a new, active strategy.
Perhaps the ultimate alpha in life is simply returning to the preliminary steps, plugging the foundational leaks, and counting the cost before you proceed.
Remember that the next time you are tempted by the curated, picture-perfect view from the mountaintop, before you obsess over the peak, ensure your boots are tied, your supply lines are secured, and you have truly earned the right to begin the climb.